Hello and welcome to my YouTube channel. In this video we will talk about the latest topic in finance. If you want to know about the Silicon Valley Bank, then you are at right place. In this video, I will tell you about the Silicon Valley Bank, its history and why it is in news. Silicon Valley Bank, SVB, was a bank based in California that was one of the largest banks in Silicon Valley. It was owned by a larger bank company called SVB Financial Group and was regulated by the government. On March 10, 2023, the bank failed because many people took their money out all at once. The government took over the bank and created a new bank to take care of people's deposits. Most people had insured deposits, which means the government will cover their losses. But some people had uninsured deposits, which means they might lose some money. SVB had offices in many countries around the world. Silicon Valley Bank, SVB, was founded in 1983 by Bill Biggerstaff and Robert Medeiros, who wanted to collect deposits from businesses financed through venture capital. The bank later expanded into banking and financing venture capitalists themselves, and added services to keep clients as they matured from their startup phase. SVB added real estate loan business, making up 50% of its portfolio in the early 1990s, but faced loss during the California real estate market slump in 1992. During the dot-com bubble in the 1990s, the bank was willing to lend to venture-stage companies that were not yet profitable, and it moved its headquarters from San Jose to Santa Clara. The bank continued to add branches in technology hubs across the country. SVB received a $235 million investment from the federal government in exchange for preferred stock and warrants under the Troubled Asset Relief Program, TAP, during the 2007-2008 financial crisis. In 2022, the bank began to incur steep losses following increased interest rates and a major downturn in growth in the tech industry, where the bank's liabilities were heavily concentrated. On March 10, 2023, the bank collapsed due to factors such as poor risk management and a bank run driven by tech industry investors. The California Department of Financial Protection and Innovation, DFPI, issued an order taking possession of SVB, citing inadequate liquidity and insolvency, and appointed the FDIC receiver. The failure of SVB was the largest of any bank since the 2007-2008 financial crisis by assets, and the second largest in US history behind that of Washington Mutual. Why Silicon Valley Bank is important? The bank mostly served businesses and wealthy people in industries like technology, healthcare, private equity, venture capital, and premium wine. It was known for being willing to help startup companies in India, even if their founders didn't have social security numbers. As of December 31, 2022, 56% of the bank's loans were to private equity and venture capital firms. 14% were for mortgages to rich people, and 24% were for companies in technology and healthcare. Of those loans, 9% went to startup companies in their early or growth stages. Silicon Valley Bank was part of a group of banks overseen by the government called the Federal Reserve System. It also joined many organizations related to technology and banking. The bank supported a women's cycling team called EF Education Tipco SVB since 2007, and became one of the main sponsors in 2015. How the bank collapsed? In early March, the bank sold $21 billion of investments to use the money for new investments, but this caused a loss of $1.8 billion. They also offered to sell $1.25 billion of their stock and $500 million of another type of investment. The next day, the bank's shares dropped by 41%, which worried people about the bank's financial position. The CEO told customers not to worry. On March 10, important investors told businesses to take their money out of the bank, and the bank's shares were stopped from being traded after falling a lot. The US Treasury Secretary was keeping an eye on the situation. Later that day, a California regulator closed the bank and put the Federal Deposit Insurance Corporation in charge after the bank's shares fell 66% in pre-market trading. If you like this video, please like, share and subscribe.